Inflation just had its best month in almost a year. The Federal Reserve should be getting ready to cut rates. Instead, traders are betting on a hike. In the next few minutes, you'll see the exact number buried inside the Fed's own projections that explains this, a number almost nobody covering the headline inflation report is talking about. Because underneath a cooling headline number is a warning the Fed's new chairman just doubled down on. And depending on what happens next, it changes your mortgage rate, your savings yield, and your monthly budget for the rest of the year. Let's start with the headline. In June 2026, U.S. inflation fell to 3.5% year-over-year, down from 4.2% in May. That's the biggest one-month drop in 5 years. Energy prices, which had been rising sharply, cooled off fast after a ceasefire between the U.S. and Iran eased pressure on oil markets. On the surface, this looks like exactly the kind of report that would make a central bank relax. But 3 days after that report came out, the Federal Reserve didn't even blink. On June 17th, the Fed voted 12-0 to hold interest rates at 3.50 to 3.75%. Unanimous. No dissent. This was also the first policy decision under the Fed's new chairman, Kevin Warsh. A unanimous hold on a cooling inflation report isn't unusual by itself. What happened next is: to understand why this decision matters, you need to understand what the Fed is actually trying to balance. Congress gave the Federal Reserve what's called a dual mandate: keep prices stable, and keep employment as high as the economy can sustainably support. Those two goals usually don't conflict. But when they do, when fighting inflation risks slowing hiring, or when supporting jobs risks letting prices run hot, a single interest rate decision stops being a formula and becomes a genuine balancing act. Alongside that decision, the Fed raised its own forecast for inflation this year. Its preferred inflation gauge, called PCE, was projected at 2.7%. The new projection, 3.6%. That's a full percentage point higher, in the same meeting where the headline number was falling. The Fed doesn't move that number lightly. Here's something most headlines skip entirely: the Fed doesn't actually target CPI, the number reported every month on the news. It targets PCE, personal consumption expenditures. The two measure similar things but calculate them differently. CPI tracks a fixed basket of goods a typical household buys. PCE adjusts for substitution. If beef gets expensive and people buy more chicken instead, PCE captures that shift quickly, while CPI is slower to. PCE also pulls in business and employer spending data, not just what consumers report buying in surveys. In practice, PCE tends to run a little cooler than CPI on average, which makes it even more notable that the Fed's PCE forecast went up in the same month the more commonly quoted CPI number went down. So if the number everyone sees is falling, but the number the Fed actually targets is rising, what is the Fed looking at that we're not? The answer is underneath the headline. Strip out food and energy, the two most volatile, temporary categories, and you get core inflation. In June, core inflation eased only slightly, to 2.6%. Shelter costs, the single biggest expense in most households' budgets, are still running at 3.3%. Energy dropped because of a one-time geopolitical event, not because underlying price pressure went away. That's the part the Fed doesn't get to ignore. Shelter costs are also unusually slow to reflect reality. The CPI shelter component is built mostly from existing leases, which typically renew once a year, so it can take 12 months or more for a cooling rental market to actually show up in the data. That lag is exactly why the Fed treats a single one-month improvement with caution. That caution has a recent history behind it. Back in 2021, as pandemic-era prices first started climbing, Fed officials, like many economists at the time, described the inflation as transitory, expected to fade on its own within months. It didn't fade quickly, and the Fed ended up raising rates aggressively to catch up, a sequence policymakers have since pointed back to as a lesson in acting too slowly. That history is part of why a brand new Fed chairman, taking over at a moment of falling but not fully tamed inflation, is choosing to sound more cautious than the headline number alone would suggest. It's worth pausing on that energy number specifically, because it's doing a lot of work in June's headline drop. Energy prices don't usually move because of gradual supply and demand shifts, they move because of events. A ceasefire easing fears of a wider Middle East conflict pulled a geopolitical risk premium out of oil prices almost overnight. That's real relief for anyone filling up a gas tank. But it's also exactly the kind of drop that can reverse just as fast if the situation changes on the ground, which is one more reason the Fed doesn't want to build a rate cut case on top of a single geopolitical event. Markets have noticed. Heading into the Fed's next meeting on July 28th and 29th, futures traders are pricing in roughly a 1 in 4 chance of a rate hike. Almost no one is pricing in a cut. That's a real shift. A few months ago, cuts were the expected direction. A quarter-point hike might sound small. But rate decisions don't move in isolation, they reset the baseline that mortgages, business loans, and credit cards get priced against for months afterward. Markets had spent the first half of the year expecting the opposite direction entirely. A shift from cuts or coming to a hike is plausible is exactly the kind of repricing that ripples through bond markets long before most people see it reflected in their own bank's advertised rate. Start with the most direct effect, borrowing. If the Fed holds or hikes, mortgage rates have less reason to fall. Anyone waiting for a cheaper home loan may be waiting longer than they'd hoped. The same logic applies to car loans and credit card interest, both of which track the Fed's benchmark rate closely. Businesses that borrow to expand or hire face the same math. Higher for longer money is simply more expensive money. Put an actual number on it. On a typical $400,000 mortgage, each quarter-point move in rates shifts the monthly payment by roughly $60 to $65. That's not dramatic on its own, but it compounds. Someone who could have locked in a lower rate before this repricing is paying that difference every single month for the life of the loan, which on a 30-year mortgage adds up to more than $20,000 over time. Multiply that by millions of borrowers, and a small quarter-point decision becomes one of the more consequential things the Fed does all year. It's not all bad news, though. The same rate environment that punishes borrowers rewards savers. High-yield savings accounts, money market funds, and short-term CDs have kept paying more than they have in over a decade. If the Fed holds steady or hikes, that's likely to continue a little longer. If it eventually cuts, expect those yields to start drifting back down. There's a slower moving effect too. Higher borrowing costs tend to cool business investment and hiring over time. That is, quite literally, the mechanism the Fed relies on to bring inflation down. So far, the labor market has stayed resilient despite more than a year of elevated rates. Whether that resilience continues is one of the two variables, inflation and jobs, the Fed is watching most closely, tied directly back to that dual mandate we talked about earlier. So how do you know which way this goes before July 28th? Watch three things. First, the next CPI report. Does core inflation keep falling? Or does June's drop turn out to be a one-month blip driven mostly by that energy ceasefire effect? Second, shelter costs specifically. Any real cooling there is a far stronger signal than the headline number, because of the reporting lag we talked about earlier. Third, the monthly jobs report. If hiring stays strong, the Fed has more room to stay cautious on inflation without worrying about the other half of its mandate. Line those three up yourself, and you'll know more heading into that meeting than most headlines will tell you. This kind of gap, a friendly headline number sitting on top of a more cautious set of numbers underneath, isn't unique to this month's report. It shows up almost every economic cycle, unemployment falling while wage growth quietly stalls, growth numbers looking strong while manufacturing contracts, one inflation measure cooling while another lags behind it for months. The skill here was never memorizing this month's figures. It's knowing where to look underneath the headline every time a report like this lands, because the headline is written for a scroll, and the people actually making the decision are reading the appendix. So that's the real reason. Not a mystery, not a conspiracy, a central bank that got burned underestimating inflation once already, watching one number the public sees and another the public mostly doesn't, and choosing not to take a single falling headline at face value. The headline told you inflation is cooling. The Fed's own numbers told you it's not fully convinced yet. That gap is what makes this decision closer than anyone expected a few months ago. We'll be back before the July 28th meeting to break down what the Fed actually decides, and what it means next.